Hey, good evening. It's Stephanie Donnell with Capstar Lending. Thank you so much for reaching out. So the purpose of this video is to, number one, explain what's going on in the market because there is a lot of misinformation out there. And I also want to discuss what's actually happening in the mortgage market and with interest rates. The second reason is just to set proper expectations in this new world of mortgages moving forward into the unforeseeable future. So first things first, 2 weeks ago, we had a significant interest rate drop, almost 1% over a 6-day time frame. So this caused an absolute frenzy in the market of people trying to apply for loans. So what ended up happening, the stock market significantly declined. Usually this is a really good thing for mortgages because that money from the stocks would float into safer investments such as mortgage bonds, like mortgage-backed securities. So money does not float to the Fed. So I'll get into that in a second because the Fed has nothing to do with mortgages. So what it does is it floats into mortgage-backed securities or bonds. So like I said, into a safer investment. So this time it did not happen. And what happened was rates went down really fast. The stocks continued to decline and people were not placing their funds into bonds or mortgage-backed securities. So that made rates go up in like a whiplash effect. So about 1% the other direction. Okay, so there was a lot of confusion. Like everyone was contacting me. Why are rates not lower? Why did this change? So this is why. So companies, banks, financial institutions were forced to sell their assets like treasury bonds that they were holding, which then pushed up interest rates. So they had to do that for cash. So they needed the liquidity. And they needed it because we had over $10 trillion of opportunity that presented itself with the rate decline. And our mortgage industry is only capable of about $2.5 to $3 trillion of loans in a year. So 10 trillion almost broke the financial system. So what you saw was interest rates go up so that they could slow down the applications. So Sunday, the Fed had an emergency meeting and cut the Fed rate to 0. So a couple of things to know. Number one, the Fed rate does not control mortgage interest rates or mortgage-backed securities. And number two is when they lower it, it affects things like your credit cards. So you're going to see probably 1% decrease on your credit card statement. And it also affects home equity lines of credit. So those should go down as well, and even your auto loan maybe. So those are good things, and those are things that are tied to the Fed funds rate. Mortgages are not directly related and not directly affected by the Fed funds rate. So do not get caught up in the 0% interest Fed funds rate. I think it could be a good thing long term for us or a bad thing short term if it doesn't stimulate the economy, because that's what the Fed is trying to do. They're trying to stimulate the economy. So now what the Fed did, what they did say is that they're going to do something called quantitative easing, which is what they did. It's the same thing that they did after the housing crash in 2008. So it's where they come in and they stimulate the economy by purchasing these bonds, treasury bonds, these mortgage-backed securities in order to keep interest rates low. So they said they are going to do that again, about $700 billion of injection that was supposed to start immediately. So notice they did not say trillion, they said billion. So it doesn't mean that rates are going to plummet again, but what it does mean is that they are going to go down systematically over the next couple of weeks and months, and it's going to present a lot of opportunities in a more controlled manner so it doesn't break the system. So hopefully that makes sense and gives you a better understanding of what's going on. It is a little crazy out there, but I just want to tell you, please be patient with myself or any other lender that you might be working with, because things are going to take a little bit longer over the next few weeks. And we're just trying to figure out where the market wants to be And I don't recommend going in and trying to lock right away, or paying a bunch of fees and doing these things if you're looking to refinance. So if you are looking to purchase, then let's make a good decision together. But if you are looking to refinance, don't be in a rush. So get everything set up, get your application in, get your docs submitted, take your time. It's going to take a month or so for this mortgage to figure out where it wants to be, but it's going to be really good. So if you have any questions, definitely reach out to me. Please let me know. We'll get back to you as soon as we can. It might be up to 48 hours before we get back to you, because I've received a ton of emails and texts in the last 40 hours. So I am on top of this stuff, and I thought it might be easier to just get some basic information out to you. And we will follow up with you ASAP. So thank you so much and have a great day.